The checks hitting bank accounts this February look different than anything we've seen in years. And if you're counting on Social Security, SSI, SSDI, or VA benefits, what's changed could mean hundreds more dollars in your pocket, or confusion if you're not prepared. Right now, millions of Americans are discovering adjustments to their monthly payments that weren't there before. We're talking about cost of living increases that actually reflect what you're paying at the grocery store and pharmacy. New income thresholds that determine who qualifies and who doesn't. Updated rules about earnings limits if you're still working part-time. Changes to how your benefits coordinate if you're receiving both Social Security and VA compensation. Even the payment schedule itself has shifted for certain groups. The problem? Most people find out about these changes when they check their bank statement and see an unexpected amount, or worse, when they unknowingly trigger a rule that reduces their payment. Here's what's actually happening with your February 2026 check, the raises everyone's talking about, and the 3 rule changes that could affect your household income starting right now. Let me start by telling you something that might surprise you. When the Social Security Administration announced the cost of living adjustment for this year, the percentage might have seemed modest at first glance. But when you break down what that actually means for your monthly budget and your annual income, the numbers tell a completely different story. We're looking at one of the most significant updates to the entire benefits system in recent memory. And it's not just about the raise itself, it's about how that raise interacts with new rules, new thresholds, and new opportunities that, frankly, a lot of people are missing out on simply because nobody's explaining this stuff in plain English. So let's talk about what's really happening with your money. The cost of living adjustment that kicked in at the beginning of this year was calculated based on inflation data from the third quarter of last year, which means it's reflecting the actual price increases you've been experiencing at the gas pump, at the supermarket, when you're paying your utility bills, and especially when you're picking up prescriptions at the pharmacy. Now, depending on what your monthly benefit amount was before this adjustment, you're looking at anywhere from an extra $40 to well over $100 added to your check each month. And I know that might not sound like a fortune when you first hear it, but think about this. An extra $75 a month is $900 a year. That's enough to cover a couple months of groceries or help with those property tax bills or finally get that dental work done that you've been putting off because Medicare doesn't cover it. But here's where things get interesting, and this is the part that a lot of folks aren't hearing about. The raise itself is just one piece of a much bigger puzzle. The earnings limit for people who are receiving Social Security benefits but still working has also gone up. Now, if you're under your full retirement age and you're still pulling in some income from a part-time job, or maybe you're doing some consulting work or you've got a small business on the side, there's a limit to how much you can earn before Social Security starts reducing your monthly benefit. That limit has increased significantly, which means you can now earn more money from work without seeing your Social Security check get smaller. For a lot of people who want to stay active, who enjoy working, or who frankly just need that extra income to make ends meet, this is a game changer. You're no longer stuck in that impossible position where earning an extra $1,000 from work costs you $500 in reduced Social Security benefits. And then there's the SSI side of things, which operates on completely different rules but is experiencing equally important changes. Supplemental security income is designed for people who have limited income and limited resources. And the resource limits have been a major point of frustration for years. We're talking about outdated numbers that haven't kept pace with reality, making it incredibly difficult for people to save any money or have any kind of financial cushion without risking their benefits. Well, some of those resource limits have finally been adjusted. The amount of money you can have in the bank, the value of property you can own, the way certain assets are counted, all of this has been updated to reflect something closer to the actual cost of living in 2026. What this means in practical terms is that you have more breathing room. You're not forced to spend down every last dollar just to remain eligible. You can actually have a small emergency fund without panicking that it's going to disqualify you from the assistance you desperately need. Now let's talk about SSDI, because disability benefits are going through their own set of changes that deserve serious attention. If you're receiving Social Security disability insurance, your payment is also seeing that cost of living increase, but there's more happening behind the scenes. The trial work period rules, which allow you to test your ability to work without immediately losing your benefits, have been adjusted. The amount you can earn during this trial period has gone up, and the way Social Security evaluates whether you're engaging in substantial gainful activity has been clarified in ways that actually make sense. This is huge for people who want to try returning to work but are terrified of losing their disability benefits and then finding out they can't actually manage the job. You now have more flexibility to test the waters, to see if you can handle part-time work, to figure out if your medical condition has improved enough that employment is realistic, all without immediately pulling the rug out from under your financial stability. For veterans receiving VA benefits, the updates we're seeing this year are creating some really interesting interactions with Social Security. A lot of veterans receive both VA compensation and Social Security retirement or disability benefits, and understanding how these two systems work together has always been complicated. The good news is that VA compensation doesn't reduce your Social Security benefit. These are two separate programs, and you're entitled to both if you qualify for both. But what's changed is how certain VA programs are calculating income limits for things like pension benefits or aid and attendance. The VA has updated their maximum annual pension rates, which means if you're a wartime veteran with limited income, you might now qualify for VA pension benefits that you didn't qualify for last year, or your monthly pension amount might have increased. And if you're already receiving both Social Security and VA pension, you need to understand exactly how these increases stack up and whether any of the new income thresholds affect your total household income. Speaking of February 2026 checks specifically, let's get into the actual payment schedule because this is where a lot of confusion happens. Social Security doesn't pay everyone on the same day. Your payment date depends on your birth date and what type of benefit you're receiving. If you've been getting Social Security benefits since before May 1997, or if you're receiving SSI, you typically get paid on the 3rd of the month. But if you started receiving benefits after that date, your payment comes on the 2nd, 3rd, or 4th Wednesday of the month based on your birthday. Now here's the thing that trips people up every single year. When the 3rd of the month falls on a weekend or a federal holiday, the payment gets moved to the last business day before that date. February 3rd this year falls on a Tuesday, so those payments should go out as scheduled. But for everyone else, you need to check the actual calendar and figure out which Wednesday you're supposed to get paid, because calling the Social Security office in a panic on the wrong day just clogs up the phone lines for people who actually have emergencies. And while we're talking about payments and dates, let's address something that causes massive amounts of stress every single year. Sometimes your payment might be a day or two late showing up in your bank account. And before you spiral into thinking something's gone wrong or your benefits have been cut off, understand that different banks process deposits at different times. Social Security sends the money out on the scheduled date, but your bank might take an extra day to post it to your account. This doesn't mean there's a problem with your benefits. It means your bank has processing times, and those times can vary, especially around weekends and holidays. The best thing you can do is know your payment schedule, give it a business day or two, and only start making phone calls if the money genuinely hasn't shown up after a reasonable amount of time. Now let's get into the Medicare side of this equation, because your Medicare premiums come directly out of your Social Security check for most people. And those premiums have changed this year too. The standard Part B premium has been adjusted, and depending on your income, you might be paying more or less than you were last year. Here's what a lot of people don't realize. Medicare uses your income from 2 years ago to determine what you pay in premiums today. So the premium you're paying in 2026 is based on your income from 2024. If your income has gone down significantly since then, maybe you retired, maybe you lost a spouse, maybe you had some other major life change, you can actually file an appeal and request that Medicare recalculate your premium based on your current income instead of that old tax return. This can save you hundreds of dollars over the course of the year, but you have to actually request it. Medicare doesn't automatically adjust this for you. Another thing that's changing, and that a lot of people are completely unaware of, is how Social Security is handling overpayments. For years, if Social Security decided they'd overpaid you for any reason, maybe there was an error in calculating your benefit, maybe you didn't report some income you were supposed to report, maybe there was just a computer glitch, they could demand that entire overpayment back immediately or start withholding your entire monthly check until the debt was paid off. This has caused devastating financial hardship for people who are living on fixed incomes and who suddenly find themselves with no money coming in. Well, the rules around overpayment recovery have been reformed. Social Security now has to give you more options for repayment. They can't just take your entire check. They have to work with you on a reasonable repayment plan. And the threshold for what they consider a hardship has been adjusted so that more people qualify for reduced repayment amounts or even forgiveness of the overpayment in certain situations. If you've received an overpayment notice, do not ignore it, but also do not panic and do not assume you have no options. You have rights in this situation, and the system has finally been adjusted to acknowledge that taking away someone's only source of income is not a reasonable way to collect a debt. Let's also talk about the tax implications of all these changes, because depending on your total income, you might owe federal income tax on a portion of your Social Security benefits. A lot of people are shocked to discover this. They assume Social Security is completely tax-free, but that's not how it works. If your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security benefits, exceeds certain thresholds, then up to 85% of your Social Security benefits can be subject to federal income tax. Now, those thresholds haven't changed in decades, which means that as your benefits increase with cost of living adjustments, more and more of that benefit can potentially become taxable even though your actual purchasing power hasn't increased. This is one of those quiet problems that doesn't get talked about enough. You're getting a raise to keep up with inflation, but because the tax thresholds are frozen in time, you might end up owing more in taxes, which effectively reduces the value of that raise. There's been talk about adjusting these thresholds or changing how Social Security benefits are taxed, but as of right now, the rules are what they are, and you need to plan accordingly. For people who are thinking about claiming Social Security benefits for the first time, the increases we're seeing this year affect your potential benefit amount as well. Your Social Security benefit is calculated based on your highest 35 years of earnings, and those earnings are indexed for inflation. The indexing factors have been updated, which means your benefit calculation might be slightly higher than it would have been under last year's factors. It's not a dramatic difference, but every dollar counts. And if you're trying to decide whether to claim benefits at 62 at your full retirement age, or wait until 70 to get those delayed retirement credits, all of these numbers matter. The break-even analysis you're doing, trying to figure out at what point claiming early versus claiming late ends up giving you more money over your lifetime, all of that math is affected by current benefit amounts and cost of living adjustments. The bottom line is this. February 2026 represents a snapshot of a benefit system that's in the middle of some really significant updates. Your check is bigger. The rules around earnings and resources are more flexible. The protections around overpayment recovery are stronger. The coordination between different benefit programs is clearer. But none of this does you any good if you don't understand how it applies to your specific situation. Every person's circumstances are different, and what represents a huge opportunity for one person might be completely irrelevant to someone else. The key is understanding what's changed, knowing where to find accurate information, and making informed decisions based on your actual financial picture, rather than assumptions or outdated information that might have been true 5 or 10 years ago but doesn't reflect current reality.